Okay, so that's a proprietorship. For partnerships, what's the main difference between a proprietorship and a partnership? Two or more people. Yeah. So, and similarly, the advantages and disadvantages are very similar. They take on a little bit different flavor only because we're talking more than one person's. Same as a proprietorship and the advantages. What were the advantages of a proprietorship? Simple and inexpensive, and it isn't a partnership as well. All you got to do is have a verbal agreement that says we're going to be partners. You don't have to have a written agreement. It's a good idea to have a written agreement, but you don't have to have one. And then you just need to go down and file with the state that you've created a partnership. Okay? You have to go out and get federal ID numbers and state ID numbers and those types of things that you might need on a proprietorship too. But very simple, relatively simple, inexpensive to start. Need that business license to get going. And in a partnership, whose money is in that partnership's account? The partners. Can the partners take out what money they want? Can one partner take all the money out of the bank account? They ought to have bylaws, but unless the bank is involved in those bylaws, one partner, if they've got single signature authority, can take all the money out of the account. Now, in the bylaws, then, you could go civilly prosecute the partner that did it. Most partnerships, though, don't have written agreements with bylaws. Most partners just have a verbal agreement. Hey, I like you. You're a nice person. It will be fun to work with you. Let's start a business. You put in this much money. I'll put in this much money. And let's get started. And then when someone takes more money out than the other, all of a sudden memories get very faint. I thought we talked about that. Didn't we say that was all right? Okay? And so all of a sudden that's a problem. That's the reason why written agreements add value to a partnership. Okay? So, plus side is simple and inexpensive. Downside to a proprietorship was what? What's that? Tied to the owner. And every partner, a partnership is tied to each owner individually. And in a case of a verbal agreement, a partnership cannot survive the exit of one of the partners. And so if one of the partners just says, I want out, you got 5 partners and you're going to go down to 4, you don't have a written agreement providing for that, the partnership will cease to exist. And you'll have to recreate a new partnership with only 4 partners in it. If you only had 2 partners to begin with, and one partner comes out, is there any way for that company to survive? So tied to the owner can be a major problem in a partnership. What's the second disadvantage to a partnership? Personal risk. Every partner bears 100% of the risk of that business. In the event that that business fails, who do you think the creditors are going to go after? The one with the deeper pockets. Because every partner bears 100%, regardless whether they're 2% or 50% or 75% partner, they bear 100% of the risk. A little bit scary, isn't it? Depends upon which partner you are. I mean, if you got 2 partners and one of them's been saving all their life, got equity in their home, and the other one's thrown caution to the wind, only assets are a beanbag chair and a stereo system, which one are they going to go after? Another advantage that a proprietorship doesn't have that a partnership does is synergy. Synergy is the process of having 2 people blend talents, and the total of the 2 is better than individually the 2 working together. You got one person that's great at production and one person good at sales. Individually, they wouldn't be too successful, but when you blend those talents, you have a powerful combination, and that's synergy. And it's a real thing, and it makes a difference. I mean, if you've ever been in with a friend on a brainstorming session, you have felt synergy, okay? And that's what it is. It's nice knowing there's someone else there that's working with you. But the downside of that synergy is what? Yeah, that's it. Getting along. Personalities. You got to be pretty synergistic and pretty understanding of each other. I mean, sometimes you see your partner more than you see your spouse. And you may or may not find your partner to be physically attractive, but at one time you might have thought your spouse was physically attractive. So at least you had that going for each other. But personalities Personalities are a major issue. 70% of partnerships don't last a year. Almost 3 out of 4 fail within a year. And it's not because they weren't making a profit. It's not because they didn't have a good idea. It's not because they didn't have potential. It's because, as a general rule, they have trouble getting along.
The other one doesn't show up.
That could be. Yeah, you've had that experience, haven't you, Sandy? What, one person works hard, doesn't show up. Here's another example. One takes more money out than they were supposed to. One spends all of his or her time out on the golf course, golfing with customers, and the other one that's sitting in the office gets sick and tired of feeling like they're doing all the work. A lot of personality issues come into play, okay? Even family of the partners can sometimes be a factor in creating problems. Another reason why a written agreement is so valuable is because it forces you to sit down and talk over issues that later could be a thorn in your side, but you establish them first. Like, for instance, how many hours will each of us work? What will each of us do in our job? What decisions will you make versus me? How will we share profits? How will we share losses? Those are all key components that if you establish it early on and you have a good trust between you, you already know how to handle those sticky problems later when they become issues. And so the more you're able to get out written, the better off and the more likely you'll be successful. Not all partnerships fail. Just recognize that personalities can become a serious issue in a partnership. Now, we'll talk about corporations in just a minute. Corporations, you might have more than one person owning this business, right? Okay, just like a partnership. But the difference is in a corporation is a shareholder can get out of the corporation and the business continues to exist. In a partnership, if one of the partners wants out, what likely will happen to that partnership? It will close. Okay, so the partnership ceases to exist, and that builds into those statistics. Although, you know, to the public, they might just see one fewer person behind the counter. You know, they might see the same thing going on. They might not know all this has happened. But to the state and to the federal government and all those businesses where we have to get our numbers, they know that it's a new business has been started. And for accounting purposes, too, the business ceases. We cease the accounting the day the business stops, and we start a new set of books with the new partnership. Okay? So it requires some efforts on our part as accountants as well. Okay, so you need to be careful in a partnership. Now let me explain that there are different types of accounts in the capital section, whether you're partnership or proprietorship. In a proprietorship, there are 3 accounts: owner's equity, owner's drawing, and earnings. Owner's equity, owner's drawing, and earnings. Owner's equity is the owner's investment into the business. Owner's equity is the investment. Owner's drawing is how much they've taken out of the business. Dixie mentioned earlier that whenever the owner writes a check for personal purposes, she charges it to owner's draw. So that's where any charges, any reductions of owner's investment by taking a draw goes into that account. So if they take their spouse out for dinner one night and they write a company check for it, unless there was a business purpose for that meeting, it's an owner's draw. And they need to recognize what that business purpose was. Okay? If their spouse is an employee of that business, might there be a business purpose? Owner's drawing then, and earnings, there's a lot of different titles for earnings. There's net income, there's net profit, there's profit and loss. All those different titles are the same thing as earnings. It's just and I'll use, you know, in discussing in here, we'll use different ones just to get used to those terms, because you'll see them from one company to another. They'll be used differently. Okay, but they all mean the same thing: earnings and net income and profit, net profit, and so forth. Partnership looks very similar, but instead of just having one equity and one drawing account, there will be an equity and drawing account for each partner. So you will have at least 2 equity accounts and at least 2 drawing accounts for each partner, or excuse me, per partner. So if you have 5 partners, how many accounts are going to appear in the capital section of the general ledger? 11. That's right. 5 equity accounts, 5 drawing accounts, 1 earnings account. Okay? And instead of saying partner number 1, partner number 2, we'll say Tim Smith equity, John Jones equity, Fred Anderson equity. Okay? And then the same thing under the drawing. It will actually name the partner so that you can easily see which one it is. Okay?